everyone, welcome to Finance, and in this video we're going to cover identifying market structure. Now, what is a market structure? It's actually a term used to describe the patterns formed by the interaction between buyers and sellers of assets. So when we talk about assets, it could be money market, bonds, equities or stocks, it could be forex, or even commodities. So here we are going to look at the types of averages, how to identify support and resistance, differentiate momentum and trend, and validate the existence of the Elliot Wave Theory. So first, what is average or averages? It's actually a number expressing the central or typical value of a data set within an observed period. So here we're looking at three types of averages. We have the ordinary, we have the moving averages, and the exponential moving averages, or EMA. So the first one, we have the ordinary average, which is computed by getting the sum of all the observed prices divided by the number of observed period. For example, in this case, if you're getting the average of a 50-day observation, then that's going to be the sum of all the 50 observed prices divided by 50, and you would get the average. Now, this type of average is quite slow and insensitive in identifying immediate trend because it captures the entire weight of the observed or entire data set. Now, unlike the moving average, let's say if you want to get the 10-day moving average, you just have to get the sum of the recent 10 prices and then divide it by 10. So you would get your 10-day moving average. Now, this type of average is actually more sensitive to identify immediate trend because it pays attention to the most recent, what you call this one, price. So the third one is the exponential moving averages. So the EMA is actually computed almost the same as the moving average, except that here, the most recent figures are given a specific weight. Now, this is not the perfect math on how to compute it, but this would give you the idea that in EMA, the most recent figures are given emphasis by assigning a specific weight. And this would detect immediate change in trends of the observed asset price movement. So let's try to paint the three-in-one picture. So here we're looking at the Philippine Stock Exchange prices from August 5 to September 4. But for the sake of applying the types of averages, we're only going to use the 10-day average or 10-day prices from August 19 to September 3. So here you have the ordinary average. Now the blue line is actually the average price. So if you're going to look at here, it actually captures or follow the immediate trend of those prices, but it doesn't actually give a very strong direction of the trend. So here we have the red line as the 10-day moving average. Now if you're going to look at here, it actually represents a direction, a specific direction. So even if the price is going uptrend, okay, the first half of this observation, you can see here that the 10-day moving average line is showing a delay in representing that trend. And same with the second half. If you're going to look at, we have from this point here, the prices actually started to move downward, and the moving average, if you're going to look at here, has some sort of delay in portraying the same direction. Now the 10-day EMA okay, is again very similar to the 10-day moving average, except that it is more sensitive to immediate trend. Now, if you're going to look at here, with the same observation on the first half, you can see that the 10-day EMA captures that immediate uptrend direction starting from this candle here. Okay, and if you're going to look at that peak, it was actually represented just below the candle, uh, red candle here. Now, unlike the moving average, if you're going to look at the peak of the trend was actually captured in this portion here. Okay, and going back here to 10-day EMA, you can see that um, it captures the immediate downtrend on the second half. Now, what's actually good about averages is that since they represent trend, now every crossover, okay, every uh, breakout of the average, the price crossing the average line, they can be a potential signal for buy or sell. Now, if you're going to look at here, when the price actually breached this moving average, it's actually a signal indicating a buy. And same when the price actually breached this 10-day moving average here, that was actually an indication of selling. Now, same with 10-day EMA. So how about the support and resistance? These are predetermined levels of the asset's price at which it is expected that the trading will stop or reverse. So here we have the value of the index, the PSEI from June 2020 to September 2020. Now here, this is the, let's say, the latest candle that we have here. Okay, it's a bullish uptrend candle. So you have here the um, lower wick. Now resistance is actually the ceiling, while the support is actually the floor of that immediate price. Now they can be identified using the previous levels, the previous low price or the previous high price. Now in this case, we can exactly identify this level here as your resistance, and this level here as your support. So if you're going to look at, we have some trading days which the price actually settled at that level. Same with the resistance here. You would see that some of the wicks actually um, settled at this level here. We can also grab this one, which is the lower portion of this candle here, and for your resistance, or this one. Okay, so you can identify the immediate support and resistance. Now we can also identify support and resistance using the moving averages. Now in this case, you can see that we can assume that this line here would actually serve as your resistance, and your support would be this line here. So any breach in the support or resistance can give you a signal whether that price will continue to go uptrend or will continue to go downtrend. So here you have the resistance at the, let's say, 100 moving average, and you have here the third resistance line is actually represented by the 50 moving average. We may see that the price would move along this support and resistance level. Now if we see some breakout in the support level, then that would give us a signal of a continuous downtrend. But if the price would, you know, breach the resistance, then that would give us the signal that the price may continue to go uptrend. Now we can also identify support and resistance, okay, using a range or an area. For example, this area here would be your resistance, and this area here will be your support, and those lines there. So you can see that the price may go up and down until a strong catalyst would really move the price to breach uptrend, passing through the resistance level, or a catalyst that would push the price downtrend, passing through the support level or area. So how about momentum and trend? Momentum is the speed of price changes in a short interval and used to identify the trend. So momentum is the short-term movement of the price, while the trend is actually the long-term direction of the price. So here we can see that we have an upward momentum, because if you're going to look at here, the two recent candles are showing lower wick. And if you're going to look at, most of the trades are actually on top of those ranges. So we have a bullish uptrend candle. So it's an upward momentum. But if you're going to look at this specific trend here, it would show that it's actually a downtrend. And if you zoom out, you would see that this resistance and support line here would give us the trend of a downward. So if you can see that at this point in time here, when you have lower lows, this would actually give you a signal for a sell position. So lastly, we have the Elliot Wave Theory. It's actually an analysis based on the idea that the market forms recurring wave patterns. Now, it's actually made of a 5-point motive phase and a 3-point corrective phase. Now here, looking at the Philippine Stock Exchange Index, you can't exactly, identify immediately the 5-point motive and the 3-point corrective phase of the Elliott Wave Theory unless you really pay attention to that specific pattern. Now, here, if you're going to zoom in, you will have this picture. And according to the theory, we have a 5-point motive. So here we can identify that we have the first wave here, second, third, fourth, and fifth. And the three phase corrective, we have here A, B, and C. So during the early waves, it would actually give you a buy signal. So coming from this phase here, the prices are moving sideways. And when you reach the fifth wave, that would actually give you the signal for a sell position, because the prices would start to decline. Now, if you're going to capture the same in looking at the market structure or trying to identify the cycle, it would give you this same picture. So we have here the consolidation. Okay, the stock or the index is trying to move sideways and waiting for catalyst to determine its next position. So at this point here, you can see that we have a breakout. So from a consolidation phase, the price actually started to accumulate here. So you have an uptrend here. So this is now the accumulation phase, and here, so when the price started to move in a downward direction, that would give us the idea that it's actually entering the distribution phase, wherein the market started to capitalize some gains, and this would give you the sell signal. And if we're going to look at here, the further downtrend is actually identified as the decline phase. So you have to enter buy position when there's an immediate signal that the consolidation phase is over and the price is moving uptrend, and you should enter a sell position when it actually reaches the peak and it starts to enter the distribution phase wherein the price would start to go downtrend. So that's all for this video. Thank you very much for watching, and I hope that you learned something. Please do like the video, and if you want others to understand, kindly share this video. And if you need to know more, kindly subscribe so you won't miss any future videos that we're going to make. Thanks for dropping by.